Good afternoon. Today, I would like to take you through one of the topics that we covered this semester, cash flow statements. As you know, according to International Accounting Standard Number 1, presentation of financial statements, companies are expected to present financial statements, a full set of financial statements. That includes the income statement, the statement of financial position, the cash flow statement, statement of changes in equity, and the notes to the financial statements. You find that amongst these, the cash flow statement is one of the most important financial statements that a company should produce. Why is it so important? Take, for example, when we prepare our income statement, formerly the profit and loss account, we use items to prepare our net profits that include things like depreciation, prepaid expenses, prepaid incomes. These items, in actual fact, they do not involve the movement of actual cash. As you know, the income statement is prepared according to the accruals concept, which prompts us to include incomes that have been earned, even though the actual cash has not yet been received. It also prompts us to include prepaid expenses which have been incurred but may not have been paid for. These items, they distort our net profit figure such that you'll find a company reporting very huge profits, but when you go to the bank, they may not have that kind of cash. And the problem comes now when, for example, the creditors come demanding their monies. Yes, you have reported huge profits in your financial statements, but you still may not be able to pay off your debtors, your creditors, and other obligations. So now, this is what makes the cash flow statement very important. The cash flow statement now only looks at those items that involves the movement of actual cash. That is the cash outflows and the cash inflows. It then disregards all the other items that are not actual cash in nature. So you find items like depreciation that had already been deducted when we are compiling our income statements. They need to be added back when we are preparing our cash flow statement. So what the cash flow statement aims to achieve is to give our stakeholders the position that is a mirror reflection of our bank position. The balance that we find at the bank should be exactly as that which is reflected in our cash flow statement. So how then do we prepare the cash flow statement? The cash flow statement can be prepared in two different ways. Number one, we have the direct method. And secondly, we can use the indirect method. The recommended method is the direct method, but you find the majority of companies, they do not use this method, opting for the indirect method because of the difficulty in presenting the cash flow statement using the direct method. The difference between these two is only in the operating activities, whereby when you are using the direct method, It lists all the items, the working capital items, one by one, be it the expenses. It lists all the expenses one by one, making the cash flow statement a bit clumsy. However, when we're preparing the cash flow statement using the indirect method, we then borrow the net profits from the income statement. And then we start from the net income from the net profit from the income statement going forward. The structure now of the cash flow statement has got three main headings. First one is the operating activities. When we're talking of operating activities, we're only looking at working capital items that involves the day-to-day normal business operations of the business. That is our sales, our distribution expenses, our salaries, all those items that are involved in our day-to-day operations. So this portion of the cash flow statement will actually show the cash outflows and the cash inflows that result from normal operations of the business. Secondly, we've got our investment activities. Investment activities looks at cash inflows and cash outflows from the sale of long-term assets and other investments. Then lastly, we've got our financing activities. The financing portion of the cash flow statement shows the net cash outflows or cash inflow that result from the raising of capital and servicing of our debts. That is the servicing of loans from our banks that we borrow to aid to our shareholders' equity, the capital. And these three main items, if added together, are the ones that will then give us either the net cash inflow or the net cash outflow, showing the position of the organization, whether we have managed to make more cash or we have